Are you in your 20s and 30s? Did you know that to retire in a comfortable way without depending on the state, your best option is to invest? Here in EcoNews, we are going to show you everything you need to have the perfect investment plan. To live a comfortable life, you need to have a certain amount of wealth, and one of the best ways to do this, especially for the working class, is to invest your money. You will see, you will be much richer if you start investing early. Don't forget to like and follow us to continue enjoying this excellent content. Now let's get started. Here is a great example. Let's say you decide to start investing 500 pesos per month and get an 8% return on investment. If you start at age 25 and continue that strategy until you are 60, you will have a large amount of money for retirement, give or take about 2 million pesos and a little more. But if you start investing at 40 instead of 25, you would only have much less money than the above amount. Of course, this simple example is nothing new and relies on an investment earning 8% compounded year after year without taking inflation into account. But as I said, this is nothing new, and I bet you've probably heard it a bunch of times before. For most people, this is still the best way to grow their wealth to ensure they have a nice nest egg to spend in their lean years. In short, by starting investing early, you are setting yourself up for success. Tell us in the comments, what did you think of this example? Would you dare to invest? And if you are an investor, what advice would you give to someone who is just starting to get into investing? Leave us your answers in the comments box, and we will be happy to read them. In this video for educational purposes today, we will look at some of the most important assets and investment decisions you can make while you are young. Now let's move on. Number 1. Index fund stocks. They are one of the best investments you can make before you turn 40, although while they can be very high risk, the returns are among the highest. As you begin your investment journey, you have plenty of time to make and learn from mistakes, but you should always make smart, calculated investments. Stocks have an average rate of return of 10% based on the S&P 500 index as a benchmark. The truth is that not many investments will have such a high rate of return. As you build your index fund portfolio, consider adding bonds as well. While bonds may have the lowest rate of return, they are the safest. You should make sure your portfolio has about 10 to 20% weighted bonds. This ensures that your investment is safer. Additionally, you could add the percentage and adjust it according to your risk appetite, such as cryptocurrency funds, which can have a significantly high rate of return. But as the rate of return increases, so does the risk. A big advantage of index funds is that they have low fees. But what does that mean? The lower the fees, the more returns. When buying index funds, be sure to consider the tax implications as well. If you are liking the video, subscribe to the channel and feel free to go to our playlist where you'll find more content like this on the channel. Number 2. Real estate. You will almost never go wrong with real estate, and it is one of the best assets for multiple reasons. First, there is almost always a shortfall in housing, and real estate assets almost always appreciate in value. The first step in real estate investing is buying your own home. Owning a residential property reduces your expenses, such as rent and other important factors. Once you have gained your own home, you can consider building other commercial properties. These can be unit housing, retail, office, and other properties. However, if you are unable to invest directly in the real estate market, there are other options available. There are several crowdfunding platforms where you can invest little. The money invested would be collectively invested in real estate properties along with contributions from other investors. These investments are known as real estate investment trusts. Before we go on with one of the most fundamental points, don't forget to subscribe, turn on the little bell, and give us a like. Number 3. Education. Statistics indicate that your 20s and 30s are the best time to study and acquire new knowledge. Therefore, it might be the best time to get that extra degree. Acquiring education is important, as it can set you up for career success. However, you must understand that not all education or learning is an asset. When doing this, Be careful because some learning can be called hobbies and probably cannot be monetized. If you want to invest in education, start by looking for careers that you are used to and that can bring you success. This could also be the best time to improve your financial literacy. Number 4. New venture. Invest in a new business venture while you are young. As with a business, the returns are unlimited and you will have the ability to earn as much as you can. With a limited prodigy, the opportunity for an explosive ROI is incredible. Even if you are not the next Amazon, investing in a business when you are young can generate incredible returns. You don't necessarily have to start the business yourself. You can invest in other people's businesses in exchange for shares in their businesses. For example, you could be an angel investor, and this is a great option. If you know the founder, your investment could be in the form of a convertible note, which means it could be converted into a loan if specific criteria are met. Tell us in comments what you think about this example. Do you agree? If not, what would you change? Leave us your answer in the comment box and feel free to subscribe to EcoNews for more content like this. Another way is through crowdfunding. There are multiple crowdfunding sites with amazing startups that have high potential. Before investing in a company, be sure to read in depth about the founder and understand the story behind the company. Choose companies that have a strong history and are backed by founders who have some education, experience, or training in the entrepreneurial industry. Another method is to work with a venture capital fund. You can become an accredited investor and proceed to become a venture capitalist. However, these funds require a minimum investment amount and have strict requirements. Number 5. Treasury bills. Treasury bills are necessary investments for every investor, regardless of age. There is no better time to buy treasury bills regularly than when you are young. They are short-term debt instruments guaranteed by the government, issued to finance spending and control the money supply, having 3 terms from 90 days to 182 days and one more term of 364 days. Everyone has bills to pay, be it tuition, rent, or even professional exams. You can easily invest the money you have on hand in treasury bills and withdraw money when the bills are due. This falls under the financial concept of asset-liability matching, which involves the purchase of an asset to fund the payment of a future liability. Treasury bills are entirely risk-free, so the returns are guaranteed, unlike other investment options. Adding on top of that, their yields are pretty decent, so why not invest in them? Number 6. Growth stocks and dividend stocks. We've made it very clear that being in your 20s and 30s is an opportunity to make risky bets, because if you lose your money at this stage, you still have time to get it back. So investing in stocks offers an excellent avenue to put some of your money into a high-risk, high-reward venture. Growth stocks are simply stocks that are expected to grow at rates significantly higher than the industry average. These stocks generate more sustainable income and positive cash flows than their peers. On the other hand, dividend stocks tend to be stocks of companies that are financially stable and mature, meaning that share prices are less volatile than growth stocks. Dividend stocks should be included in your portfolio at an early age, providing opportunities for steady income over a long period of time, as long as the companies continue to perform well. If you are liking the video, subscribe to the channel and give us a like along with some comment with your opinion on the topic. Number 7. Exchange-traded funds. Now let's take a look at ETFs, which are quite similar to the index funds we talked about earlier. ETFs are baskets of securities with multiple assets such as stocks, bonds, and gold, making them similar to index funds. They are traded like stocks, meaning investors can buy and sell shares on an exchange. Their versatility makes them valuable tools for investing in broad market indexes such as the S&P 500 or sectors such as technology, healthcare, and even subsectors such as social media or robotics. Number 8. Commodities in economics. A commodity is an economic good, generally a resource that has total or substantial fungibility. That is, the market treats instances of the good as equivalent or nearly regardless of who produced them. There are several ways to invest in this. The first is to buy varying amounts of physical commodities, such as precious metal bullion. Investors can also invest by using futures contracts or exchange-traded products called CTP, which directly track a specific commodity index. These are highly volatile and complex investments that are generally recommended only for sophisticated investors. Another way to gain exposure to commodities is through mutual funds that invest in commodity-related businesses. Here's an example: an oil and gas fund would own shares issued by companies involved in energy exploration, refining, storage, and distribution. The advantages of investing in commodities are portfolio diversification, potential return, and a potential hedge against inflation. In addition, commodities have shown stronger performance during periods of inflation, making them one of the best assets to own. Number 9. Annuities. An annuity is a contract between you and an insurance company in which the company agrees to make periodic payments to you, beginning immediately or at some point in the future. You purchase an annuity, either with a single payment or a series of payments called premiums. Some annuity contracts provide a way to save for retirement. Others, however, can convert your savings into a stream of retirement income. Still others do both. If you use an annuity as a savings vehicle and the insurance company delays your payment into the future, you have a deferred annuity. On the other hand, if you use the annuity to create a source of retirement income and your payments begin immediately, you have an immediate annuity. The two most common types of annuities are fixed and variable, although there is also a hybrid called an indexed annuity, also known as an equity indexed annuity or fixed index annuity. Annuities are often products that investors consider when planning for retirement, so it pays to understand them. They are also often marketed as tax-deferred savings products. However, annuities come with various fees and expenses, such as surrender charges, mortality risk charges, and administrative fees and expenses, while they can also have high fees, reaching 7% or more. Number 10. Cryptocurrencies and initial coin offerings. However, with billions of dollars raised in financings and more than 1,000 different cryptocurrencies currently available, these rapidly changing markets are enticing to investors.
Crazy, isn't it?
Don't forget to give us a like, subscribe, and turn on the notification bell so YouTube will let you know when we upload the next content.